Hello my dear students, welcome to economics classes for 12th standard. We are doing chapter number 4, that is methods of calculating national income, and today I will start our topic, that is expenditure method. So let's start the video with your Jerry sir.
So now we are going to start our third method for calculating national income, that is expenditure method. In our previous videos we have learned about our first two methods, that are value added method, and we have learned about income method. This is our third method, that is expenditure method. As the name is there, expenditure, so we are going to learn about the expenditure which we are doing on final goods. So according to this method, national income is measured in terms of expenditure. Okay, as we have in our previous methods like value added, we have find how much value we have added in each product, and then we have find national income. And in income method we have calculated what the income of the peoples, okay, working in India or in the domestic territory of India. Then we have calculated the national income. But in this we will find the national income by calculating first the expenditure done by the people of country. So under this we will going to find out the expenditure in terms of what? Purchase of final goods and services. Again I am putting emphasis on final goods. Now what is final goods? The goods which are ready to use. Means it means that no further production remain on them. Okay, that is called final goods which are ready to use. Okay, so produced in the economy during an accounting year. So accounting year, or you can say a financial year. Okay, since final expenditure comprises C means consumption, and investment, so you can say I. It is also called, as you know that when we are doing final expenditure, so some expenditure we are doing to consume things, like I am doing expenditure on purchasing some items related to the foods, like that you can say the Maggi I am purchasing. So Maggi I am consuming, I am going to consume Maggi properly. That is called expenditure consumption, because I am purchasing Maggi to consume it. Okay, I am going to use that Maggi further. Once I consume that Maggi, then it is over. Okay, that is, it is finished. Now investment, that I am purchasing something that like car. Today I have purchased a car. So one time I have taken a drive. So after taking one drive, it is not like that the car will be finished. Okay, but I can take drive tomorrow also, and after 1 year or 2 years also. So it is an investment. So final expenditure includes what? Consumption also and investment also. That's why it is also called consumption and investment method. What method? Consumption and investment method. So it can come in 1 marks questions, that expenditure method is also known as consumption and investment method. Then come what? It is also known as income disposal method. What known as? It is also known as income disposal method. So these are two more names of expenditure method. So don't be confused in this one. Okay, then we are saying that estimation of expenditure on the final goods produced during the year within the domestic territory of a country. Now the word come domestic territory. Now in the starting I have explained the meaning of domestic territory. Now what is domestic territory? It means the boundary of our country. Okay, so what they are saying, whatever the expenditure which we are doing on final goods which are produced where? In the domestic territory of our country, the domestic boundary of our country. All those goods which are produced in the domestic territory of our country, we have purchased them, so we are doing what? Expenditure on them. So only those goods is equal to market value of GDP. GDP means what? Gross domestic product. It means gross domestic income also, you can say. So it's called what? GDP at market price. So it means that after calculating these expenditure done by our people on either, you can say, on the consumption or investment method, consumption or investment basis, or you can say that done within the domestic territory. So it comes under, when we calculated that, so it will be called what? GDP at MP. Now questions strike in our mind that we are finding national income, and national income is what? National income is NNP at FC. But they are saying that after using expenditure method we are going to find GDP at MP. So it means that we, after finding GDP at MP, we have to convert it, or we can say we have to adjust it to NNP at FC, which means national income. So first we have to find out GDP at MP. Now how we can find out this GDP at MP? So the classification and components of financial expenditure, you can say classification or you can say components also, same thing only. So how we can find this GDP at MP? So for finding GDP at MP, we have to categorize our expenditure on 4 types. Like first one is private final consumption expenditure, which we can say PFCE. P for private, F for final, C for consumption, and E for expenditure. Then second coming government final consumption expenditure. Third is coming gross domestic capital formation, and last is coming net export. So first we'll talk about the first one, that is private final consumption expenditure. So what is this private final consumption expenditure? So let me tell you, dears, the consumption, or you can say the expenditure which we are doing, who are we are the consumer, which we are doing on the things, or you can say on the final goods. Okay, what we am saying, the expenditure which are done by the consumer on the final goods, to purchase the final good to consume. Okay, so that expenditure comes under private final consumption expenditure. Clear or not? Like I am saying that I am doing the expenditure. Who doing? I am doing the expenditure to purchase milk, or you can say to purchase butter. So that expenditure which I am doing on purchasing butter or milk, you can say that it is non-durable goods. So the expenditure which is done by me, or which is done by the consumer on purchasing non-durable goods, is come under private final consumption expenditure. Or you can say the expenditure which is done by consumer on durable goods. Durable goods means, like you can say that furniture, washing machines, and TV, radio, these are called durable goods. So if I am doing an expenditure on these things, so this is also, that expenditure is also comes under PFCE, private final consumption expenditure. Okay, so this expenditure is done by consumers, individuals, households, or you can say non-profit organizations, like you can say that those organizations which are helping old age home. Okay, like that. So that is called PFCE. Next is coming what? Government final consumption expenditure. Now what is this government final consumption expenditure? Let us just look at here. Government final consumption expenditure, that is GFCE. As the word is there, government. So it is the expenditure which is done by the government. Now when the government, the ruling government, those who are in those who are ruling the country, so those expenditure which is done by the government. Who? By the government on what? On the various administrative services. Because if a government is there in a ruling party, you can say that, so they have to do the various expenditures on defense, okay, on law and order, and you can say education. What? On defense, law and order, and education, and etc. Many things are there on which the government has to do some expenditure. So these all expenditures comes under GFCE, which means government final consumption expenditure. Okay, clear or not? The expenditure which is done by the government comes under GFCE. The expenditure which is done by the consumer, common people, that is comes under PFCE, private final consumption expenditure. Next is coming what? Gross domestic capital formation. Now the word is coming gross domestic capital formation. Very big word, you can say. Gross means total, domestic means that domestic only, not outside, but within the domestic territory of a country. Capital formation. Now the word is there, capital formation. Here just you have to focus on this word, that the word is coming capital formation. It means we have to form capital. So it means basically what is coming here? Gross investment. What is coming? Gross investment. You can say at the gross domestic capital formation, or you can say investment. Now what is investment? Like if I say that consumption means what? I am purchasing something, like that you have, I have given example, I have purchased butter. Okay, so I will consume that one. I am going to consume it. It will finish. Okay, after some time, because I will eat it, so it will be over. Now I can't more use it. No, I can't use it more. So that is called consumption. But when we are talking about investment, so investment is what? Like I am purchasing a land, or you can say I am purchasing a fixed asset like plant and machinery. These are called what? Investment. Because that machine is going to work for years. It is not like that one time I have used that machine, then machine is over. It is not like that. Machine is going to work for years. So I am doing investment. If I am purchasing a land, so that land I can sell out afterwards, after some years, on higher rate. So that is called investment. Gross domestic capital formation is that only. Okay, you can see here also GDCF, gross domestic capital formation, or you can say gross investment also. It refers to expenditure incurred by producers on final goods and services produced within the domestic territory of the country for investment purpose. Okay, so it contains two components. As you can see here, it is further divided into two parts, that is gross fixed capital formation. Just pay attention, gross domestic capital formation. Then it is divided into two parts, GFCF. What is GFCF? Gross fixed capital formation. And second one is what? Inventory investment. So let's learn about the first one, that is gross fixed capital formation. What is this gross fixed capital formation? You can say gross fixed capital formation, or you can say fixed investment, as the word is coming here, fixed. So what is the fixed means? It refers to the expenditure. Which expenditure? By the producers. Who are doing this expenditure? Producers. On what? On the purchase of fixed asset. If you are you're a owner of the firm, so you have to do some expenditure. If you are going to produce something, so you need machines and plants, plant and machinery and other things, fixed assets you need. Okay, like land also you need. So these are called fixed. So you can say that is expenditure which is done on the fixed assets. It comes under gross fixed capital formation. Okay, now we can classify it more as business fixed investment, and we can say fixed investment by the households in terms of construction of house. If a businessman is doing, so we can say the business fixed investment. Suppose I am doing a business, okay, so I need a plant and machine. So if I am purchasing a fixed asset like plant and machinery, and if I am purchasing a land for the purpose of constructing my building for, or you can say factory, so that is come under business fixed investment. But if I am doing you can say I am doing expenditure on purchasing a land for constructing my house, so that will come under the fixed investment by the household. Who are the household? They are the household consumers. Okay, so or you can say that fixed investment can be done by the government also. They are also purchasing some piece of land for constructing that you can say that offices, government offices, like that, no. Then come what? Public fixed investment, or you can say fixed investment by the government, like expenditure by the government on what? Now what type of expenditure can be done by the fixed expenditure can be done by the government? Like you can see the roads, dams, all these things are come, bridges, these are come under the construction by the government. This is called public fixed investment. What called? Public fixed investment. And fixed investment by the household means constructing house. Business fixed investment is what? That when a businessman is purchasing some piece of land or purchasing plant and machine, so that will come under the business fixed investment. So clear to you what is this gross fixed capital formation? Okay, or you can say fixed investment, the investment which is done on the fixed assets. Okay, then second one more is there, inventory investment. So it is very easy. Earlier you have learned already. It's simple. If you have to find out inventory investment, so what you will do? Closing stock minus opening stock. What? Closing stock minus opening stock. Now see, what is this? That a businessman who was a businessman, or you can say entrepreneur, they are producing goods. What they are doing? Producing goods. But some goods are like that, they are purchasing from the wholesale and then they are selling to the retail. Okay, so those goods are also there. So those goods are comes under inventory investment. Okay, what? Closing stock minus opening stock. Then last is coming what? Net export. We have learned about first PFCE, private final consumption expenditure. Then we have learned about GFCE, which means government final consumption expenditure. Then we have learned about GDCF, which means government gross domestic capital formation, which is further divided into two parts, that is gross fixed capital formation and then inventory investment. And last is what? Net export. As the word is coming, net export, net word is coming with this. So when the net export means export minus import. Now what is this export minus import? Now you all know what is export. Export means what? When we are selling goods outside. What? Or we can say that in other words we can say exports are the expenditure by the foreigners on the products, or you can say on the final goods and services which are produced within our domestic territories. When foreigners are purchasing our items, okay, or you can say our products, so that is called export, because then we have to send our products to foreign countries, then money will come to our country. Then what is import? When we are purchasing goods from the foreign countries, okay, so we are taking goods from that country to our country and then our money will go to that country. Clear or not? That is called export and import. Now what is net export? What is this net export? Net export means the difference between the export and import. It means export minus import. Clear or not? Yes. One more question that which is many time it comes that sometimes in question they are giving you net import. What they will give you? Net import. And what is the meaning of net import? Net import means import minus export. So suppose that if they have given net export 10, what they have given, net export 10. So in question you will write if they have given net import, what if they have given net import as 10, so what will become our net export? Our net export will become minus 10. What will it become, net export? It will become minus 10. Okay, clear or not? Don't be confusing this one. Okay, so finally we have learned about all 4 steps, these 1 2 3 4, which are the components for finding GDP at MP. So what we have to do, we have to add these all, PFCE, this one, then plus GFCE, government fund consumption expenditure, then gross domestic capital formation, which is further divided into 2 parts. If it is given directly, then no problem. If it is not given, then we have to add these 2 items. Then at last, net export. If we add all these things, so what will come? GDP at MP. What will come? GDP at MP. So as you can see here, GDP at MP equals to private final consumption expenditure, which is known as PFCE, plus government final consumption expenditure, then plus what? Business fixed investment, and you can say government fixed investment. It is what? It is only gross domestic fixed investment only. Okay, this one gross domestic capital formation. Okay, don't be confused. So in this one, what is coming? These things are coming. Okay, business fixed investment, government fixed investment, or investment on residential constructions by the household, you can say. At last, what is coming? Net export, which is export minus import. So after adding all these things, what we will get? We will get GDP at MP. But as I told you, we have to find out national income, and national income is what? NNP at FC. So it means we have to convert this into NNP at FC, and this conversion we have already learned. So as you can see, GDP at MP we are converting into NNP at FC. So first is G, and we have to find out what? N. So gross is there, we have to find out net. So in order to convert gross to net, we have to subtract what? Depreciation. So gross to net minus depreciation. Then domestic, D for domestic, we have to find out national. Domestic to national, we have to add NFIA. NFIA is what? Net factor income from abroad. At last is what? MP, market price, and what we have to find out? Factor cost, because national income is always find out on factor cost. So market price to factor cost, we have to convert market price to factor cost. So we have to subtract NIT. NIT means net indirect tax. So it means if we have to find out NNP at FC, so from GDP at MP we have to subtract depreciation, then we have to add NFIA, and at last we have to subtract NIT. Then what we will get? We will get our national income. I hope it is clear to you. Now what we have to learn? We have to learn about the precautions when we are calculating national income by expenditure method. So what are the precautions? We have to pay attention on these things, because many times we are doing mistakes when we are doing the numerical questions, because these items are coming and these items are confusing us. So what things we need to include, and what things are there which we don't need to include. So these things we have to be very clear. Okay, so let's clear these things and let's learn about the precautions. Sometimes it is coming in theory as a theory questions also. So pay attention here. What things we need to include and what things we don't need to include. Just pay attention here. So first, expenditure on final goods and services, because it causes corresponding flow of goods and services. We need to include what? Expenditure on final goods. As I already told you, it is also known as final expenditure method also, because we are adding only those, or we can say we are including only those expenditure which are done on final goods and services. So why final goods? Because it causes corresponding flow of goods and services. That's why we are including what? Final goods. Okay. Now what we should not include? So what we should not include? We should not include the expenditure which we have done on intermediate goods. Now intermediate goods are what? Those goods are which are used as a raw material to make the final goods. So when we have included the value of final good already, so if we include intermediate goods value also, so what will happen? There will be problem of double counting. So in order to avoid the problem of double counting, we should not include the expenditure which we have done on intermediate goods. Next is coming what? Second point, expenditure on commissions on sale of second-hand goods. Now take example. I can say that, okay, I have purchased a bike. What I have taken? I have purchased a bike. Okay, and after using it for, you can say, almost for 1 year, I sell it out to a person who is ready to use it, who is ready to purchase it at the same price. So I have purchased that bike at, you can say, 70,000. How much? 70,000. and I sold out that bike to one of the person at the same price after 1 year. Just pay attention. I have purchased the, you can say that I have purchased a bike at rupees 70,000, 70,000, and I sold out that bike at rupees 70,000 only after 1 year. After 1 year. So what I should do? I should include that expenditure or not? So what they are saying, we should not include that expenditure on the purchase of second-hand goods, as their value has been already accounted during the year of the production. Now let's understand what they want to say here. Actually, when we are purchasing the good, like when I am purchasing that bike for 70,000, 70,000, so that expenditure which I have done on that good is already counted. Okay. So when another person after 1 year who is ready to purchase that second-hand good, that second-hand bike from me at the same price 70,000, so we should not include that price. Why? Because if we include that 70,000 again, so what will happen? Again the problem double counting will come here, because already that value is already added during that year when it was purchased. When I have purchased that bike, that time only it was added. So once again if I will add, so it will be not counted. It will create problem. Okay. Now one more thing we have to pay attention here. What we should include then? The expenditure on commission on sale of second-hand goods. Now what happens sometimes? This example I have given, that I have purchased a bike for 70,000. Now what happens sometimes? We did not get the buyers easily. If I want to sell my bike, second-hand bike, so we did not get the buyers easily. So what we are doing? There is an intermediary come in middle, or you can say the medium person. Who's the medium person? That person who get the commission. So a person came in between us, like I want to sell my bike, and one more person is there, person B, you can say. I am the person A, and the person B is there who want to purchase bike from me, my second bike he want to purchase. So one mediator came in. Who? Mediator. I told that mediator that I want to sell my bike at rupees 70,000. How much? 70,000. So that mediator came in and he told me that okay, the one buyer is there who is ready to purchase your bike. What is that? He is ready to purchase your bike, but you have to sell out your bike at how much rupees? 72,000. At how much rupees? 72,000. But so I said to him that no, I want to sell my bike at 70,000 only. So he said, if you want 70,000, so no problem, you get 70,000. But what is there? I need what? Commission. The mediator said that I want commission on that sale of that second good bike. So I have purchased bike for 70,000, but I am selling that bike for how much? At 72,000. How much? At 72,000 with the help of a mediator. So that 2,000, no, this 2,000 which is coming extra, this 2,000 will be taken by the mediator as a commission on the sale of second-hand good, and this 2,000 will be included in the precautions, or you can say in the national income. So this 2,000 will be included in the national income while calculating it by expenditure method. Why? Because it is a service which is given by a mediator. So he will take the commission. So this 2,000 will be included. How much included? 2,000 will be included, and this 70,000 will not include. Clear or not? So that commission will include. But remember, purchase of second good will not include, but the commission on the sale of second good will include. Clear? Then coming same point as it is, we have learned expenditure on purchase of share and bonds. Now you have learned about share and bonds in accounts. So expenditure on purchase of share and bonds, either it's new, either it's old, it will not include in the national income. Why? Because it do not lead to corresponding flow of goods and services. It do not produce any productive services also. Okay, these are shares and bonds only. So they are just papers. What are they are? They are the paper. So if you are purchasing that one, if you are doing expenditure on purchasing those shares and bonds, so what will happen? Just there will be a transfer of ownership. Okay, because these are the piece of papers. So we will not include this expenditure in national income. Why? Because these are not producing any productive services. But if any brokerage you can say commission only, brokerage, if a person is getting any brokerage on shares and bonds, either it's new or you can say old, then it will be included in the national income, because it will be regarded as the service given by the render, by the broker. So he is rendering his services as a broker, so he will take his brokerage, you can say, as a commission only. Okay, so that will be included in the national income. So again I am saying brokerage on shares and bonds will be included, but expenditure on the purchase of shares and bonds will not include. So don't be confused here. Next is coming what? Imputed, or you can say estimated, which we are estimating by ourselves. Expenditure on what? On the goods produced for self consumption. Now what is self consumption? You can take example of farmer who is producing wheat. Okay, so he sell out some wheats, and some wheat, you can say, some units he has taken for himself, because at last he also have to eat some food. So he has kept some wheat for his self consumption. So the value of that wheat will be included in the national income, because these are productive services. Okay, he is producing wheats and services, wheat and rice or whatever. So these are productive services. The amount of that wheat which he is using for his self consumption will be included in the national income. And now what will be not included? Expenditure on transfer payments. Now with the name this transfer payment, I think one word came in your mind, that is transfer income. Remember transfer income? In previous video we have learned. So transfer payments by the government. Who is doing this transfer payment? Now we are talking about it, which things are not included. So transfer payments which are done by the government are not included in the national income. Now which type of transfer payment are? Like scholarship. We are giving scholarship to students, and students are not doing anything, you can say, productive services for that, but we are giving them. The government is giving them. Old age pension, giving for in return we are not taking anything. Donations. So these are not our productive service. These are not our productive services. Okay, but still the government is giving them. So these are the expenditure on transfer payment. So these expenditures are not included in national income. Clear or not? These are the points which we have learned, or you can say precautions, which we should take while we calculating national income through expenditure method. So I hope it is clear to you. Now let's check this question. Okay, we are going to solve these questions by expenditure method only. Just pay attention here. Determine national income, that is NNP at FC, from the following information. What are the information is given to us? Either you can write particulars or you can write items, and this rupees is given in crores. So first item is given private consumption expenditure, then 15,000, then is given government consumption expenditure 11,500, then depreciation is given, net factor income from abroad, net indirect tax, increase in stock, export, import, gross fixed capital formation. These all items are given here. Now first identify your items. As we have learned that in expenditure method we have to add private final consumption expenditure, which is known as PFCE, then government final consumption expenditure, which is known as GFCE, then gross domestic capital formation, which is known as GDCF, you can say, and at last net export. Okay, so first private consumption expenditure, this is also known as, we can say, as PFCE. Then government consumption expenditure, so we can say it GFCE. That is our second item. If you remember this one, private final consumption expenditure PFCE, and government final consumption expenditure GFCE. Then gross domestic capital formation, which is further divided into two parts, these two, and at last net export, which means export minus import. So let's solve this one. Now depreciation right now we don't need, because we are finding GDP at MP first. Net factor income also we don't need, that indirect tax also right now we don't need. Then increase in stock. Now what is this increase in stock here? Just think, increase in stock. Where we are using the word stock? We are using the word stock in closing stock minus opening stock. That is inventory stock. What is that? Inventory stock. Now if we further look at our question, so we are not getting where you can say closing or opening stock like that. Just we are getting increase in stock. It means it is already the balance is given closing minus opening. What is this? It is closing stock minus opening stock. So directly we can write it as inventory stock. What we can write at? Inventory investment. Directly they have given with other name, inventory statement is 200. Okay, then given export 500 minus import 700, then import given 700. At last gross fixed capital formation. What is this? This is the second part. If you remember, we have further categorized this gross domestic capital formation into two parts. So gross fixed capital formation, this is given this part, last one. Okay, gross fixed capital formation. So let's solve the question here. So we'll use our formula. We have written our formula here, as you can see. I have written short form. You can write the full question, the full form of this one. Okay. So PFCE plus GFCE plus gross domestic capital formation. As I told you, this is divided into two further parts. That is GFCF, gross fixed capital formation, and inventory stock. Now PFCE, it is given amount how much? 15,000. Okay. Then plus GFCE. What is GFCE? GFCE 11,500. Okay. Then plus, so we have to open the bracket here. Okay. Now how much this gross domestic capital formation is given? Gross domestic capital formation, it means they have given gross fixed capital formation. Same it is only gross fixed capital formation. How much? 1,000. And then inventory stock, it is inventory stock 200. So we can close our bracket. And then we have to find out what? Export minus import. So export is given how much? 500. Okay. And import how much given? 700 minus 700. Okay. So here we have put it the value already. We have put the values which are given in the question. So now we have to solve. So just solve the question now. So 15,000 plus 11,500, it will come how much? 26,500 plus then 1,000 plus 200, it comes 1,200, and then plus 500 minus 700. Here 500 is smaller than 700, so the answer will come in negative, that is minus 200. How much? Minus 200, because 700 minus 500, 200, but sign will come off minus. Now we can solve 26,500 plus 1,200, so it will come 27,500 plus 200, 700, 27,700, and plus minus 200. So if we subtract, it will come 27,500. What it comes? It comes GDP at MP. What it comes? GDP at MP. Okay. But here we have to find out what? National income. What we have to find out? National income, that is NNP at FC. So it means we have to convert this GDP at MP into NNP at FC. So GDP at MP we have to convert into NNP at FC. So first, in order to convert gross to net, this gross to net to national, we have to add NFIA, net factor income from abroad, and at last market price to FC. We have to convert this market price into factor cost, any FC. So in order to convert this one, we have to subtract NIT, which means net indirect tax. So it means we have to find out GDP at MP. We have already found out, so we have to find out NNP at FC now. So it equals to what? It equals to GDP at MP minus DAP plus NFIA minus NIT. Now we have to check these things are given or not in the question. Just check the question. Depreciation, NFI and NIT. Depreciation is given here. Net factor income from abroad means NFIA is given here, and net indirect tax, which means NIT, also given. Just put the values. GDP at MP we have found out how much? 27,500 minus depreciation given how much? 500. How much given? 500 minus plus NFIA. So how much NFIA given here? Net factor income from abroad 700. At last minus NIT. How much NIT given? 400. How much given? 400. So 400. So it will come how much? 27,500. Here 700 we can write here plus first, then minus 500 minus 400, it becomes minus 900. Okay. 27,500 plus 700 will become 28,200. Okay, then minus 900. Subtract this one and check what is coming. So if we subtract 900 from 28,200, so it is coming how much? It will come 27,300. How much? 27,300. What? Crores. Okay. So this come what? Our national income. It comes our national income, and here we have found out this national income through expenditure method. So I hope it is clear to you. Okay, so I will give some questions you can try at home. Okay, thank you class. At last I just want to say, be safe and God bless you all.